Hi guys, good morning. Arun Jayal here. I am a mutual fund distributor based in Rishikesh, and today is 6th of March 2026. The winters have set up here in Uttarakhand, and we are heading towards summer. And as always, I brought a new topic today. As we speak today, there is a ongoing conflict going on in Middle East or West Asia, and the markets are making wide swings like uh, 1% up, 1% down, or 1.5% up, or 1%, 1.5% down. So markets are swinging widely. What an MF investor should do. That is the topic. The volatility has increased as we see because of the war in Middle East, and people are trying to find their uh, trying to find values behind this volatility. People are trying to exit in huge sums. Some people are trying to buy. So there is a huge ongoing conflict of thoughts going on, and that is why there is a huge volatility. So I'll explain in 5 points what you should do as an investor. You have to understand that volatility is the price that you pay for long-term investing. So as long as you are thinking about long-term, 5, 10, 20, 30 years, this volatility should never ever deter you. You should not think about it because you know that your goal is 15, 20, 30 years from here and things will improve no matter what. And to cope this volatility, you need to check your portfolio once in a week or maybe in a month, and set it and forget it. Don't think about it. You also have to understand that this kind of uncertainty creates opportunity. When markets are making such wild swings, there is a huge opportunity for people who have a long term vision. They can enter now and they can think about 3 to 4 or 5 years of, they can take a 3 to 4 or 5 years of horizon and do good for themselves. So this also creates an opportunity for you. And SIP is the best way to enter in volatile market. SIP is always the best way to enter, but when markets are making such wild swings, SIPs is the best way to enter because via SIP you can get more units when the market is going down, and you can take advantage of uh, bull market when because you have more units. And you have to also understand that these kind of headlines create short-term noises and market volatility, and it should never deter a new long-term investor. These things will happen every time. This is a natural phenomena. These things will happen, and you have to think about long-term. There is no substitute for that. And also, finally, I would want to say that discipline always beats prediction. Once you have a long-term vision and you have a discipline, uh, then you don't need to predict. Even if you make entry at the lifetime high every time, you will get around 15-16% CAGR. That is a data that I saw somewhere, that a guy was explaining that even if you enter at lifetime high with lump sum investments, you will get good 13, 14, 15% CAGR. So you don't need to predict. You just have to keep on investing. This volatility will end and market will lower again. So the topic was that huge uh, swings are happening. What an investor should do. You have to understand that volatility is the price that you pay for being a long-term investor. You should not. It should not